Hey guys, Scott Adams, the Home Co. Today I've got Lacey Harnar with Harnar Mole CPA. She's going to talk to us a little bit about investment properties and 1031 exchanges. And yeah, stick around. This is going to be some great information. All right. Hey, thanks again for joining us. On the other side of my screen here, I've got Lacey Harnar. Lacey, why don't you introduce yourself for our viewers here?
Sure. I'm Lacey Harnar with Harnar Mole CPAs. We work with small business owners and real estate investors. Our goal is to help you understand the tax law, minimize your tax bill, and dominate in an audit.
Dominate in an audit. I like that. So, thank you, Lacey. Thank you for joining us. So in real estate, I do, and this year I got the chance to work with several people who are, really seasoned investors. And then I also get to work with the new investors too, who are just starting their investment portfolio. So from an investment property perspective, as you are, I guess pre-planning your portfolio, is there a best way to position the acquisition and management of a property that you plan on buying and holding from a tax abatement or tax deferment perspective? Can you talk to us a little bit about that?
Are you thinking, like entity structures, like if you need to have an LLC, things along those lines?
Yes, ma'am.
Okay. So I have this conversation with investors probably on a daily basis. And let me just preface this by saying I'm not an attorney, so I'm not going to give you legal advice, but I can most definitely help you from the tax side of things.
Perfect.
Okay. So you can actually buy a property in your individual name. Okay. And when you do that, you just report the rental activity, income, and expenses on your individual tax return. It's called a Schedule E, and pick it up on your individual return. What's really common, though, is that people will purchase within a single member LLC. And the reason why they want to do that is actually for asset protection. So that's where we're quickly getting into the legal side of things.
All right.
I'll stay in my lane, though, and say that
they mesh a lot there.
They do. So I'm going to make sure to stay in my lane, and I'll just leave it at IRS considers a single member LLC to be a disregarded entity. So what that means is that you're going to pick it up just as you would if you owned it in your personal name. You're still going to report the income and expenses on your personal return on a Schedule E, and the tax benefits are the same to you. It is simply for asset protection, as far as why you would consider having an LLC.
Perfect. Thank you for that. How about, is that applied whether you are buying for a buy and hold or a vacation rental property, or say perhaps you're buying and flipping a home? Would that still be the same application across all of those
Sure.
different investment property position?
There's actually going to be a little bit of a difference there. If you have a short-term rental, that can be treated the same for the most part. There are some short-term rentals that are handled a little bit differently, and that gets kind of complex, so I won't go into the details. But as long as you're treating that short-term rental, as long as you're not providing any substantial services, then you would treat it the exact same. However, you mentioned like if you're flipping, wholesaling, something like that, that gets treated differently. And you just want to make sure, if you're going to be creating LLCs for these different models of investing, you want to have two different LLCs. So buy and holds would go in one, flipping, wholesaling would go in another. And the reason why you want to do that is because wholesaling and flipping is subject to ordinary income taxes. So you want to leave yourself some flexibility. You might want to have that LLC taxed as an S corporation at some point in the future. So it's just really important to keep those types of real estate separate.
Ordinary income tax as opposed to the tax, the flips and wholesales to be taxed as ordinary income versus the other, which is taxed as?
Initially, it's the same tax rate, but it's really upon sale. So if you have a buy and hold property and you sell it, then it qualifies for the capital gains rate, which right now, depending on your income tax bracket could be as low as 0%.
Oh, wow.
So 0, 15, 20% right now. However, when you're flipping and wholesaling, you don't qualify for the capital gains rate. And actually, not only do you have to pay federal tax and state income tax, you also have to pay self-employment tax, so Social Security and Medicare. So they're just handled differently.
Yeah, that's definitely something to keep in mind. So a lot of my investors, they look at the property disposition time. So, and they're looking at their capital gains taxes for their buy and holds or their flips. And a lot of them choose an investment vehicle that allows them to defer paying those taxes at the sale of their home.
Yes.
They use a 1031 exchange.
Yes.
So can you kind of speak to us a little bit about 1031s?
Sure. So I love that you said the word defer the taxes. So sometimes people think that a 1031 just gets them out of taxes, and it doesn't, but it does defer it, which is extremely helpful. So essentially what happens when you have a buy and hold property and you sell that property, it's subject to capital gains. Well, if you are wanting to grow your wealth over time, then you have this great vehicle, a 1031 exchange, that allows you to sell a property, and rather than paying the capital gains on it, losing a large chunk of your profits and then going and buying the next property, instead you can take the profits from the first one, roll it in to the next property. This is a 1031 exchange. Now there's several different rules that you have to follow, and this is what trips people up is, make sure to do your homework on the front end. Sometimes people think they're doing a 1031 exchange and then they're not, and they realize it, and it comes back to bite them on the back end. So definitely do your homework. But the two big pieces, maybe three big pieces, is that you need to have the next property picked out within 45 days of selling the original property. Mm-hmm. And what I would recommend is don't wait to start shopping for that new property. Don't sell the first one and then start shopping. A lot of investors already have the new one determined. They've got it arranged, at least verbally, and then they sell the original property. So that's the first thing to make sure. And then the next one is you have 180 days to close on that new property. And what people will do is they think the 180 days begins after that 45, and it doesn't. The 180 days actually begins upon sale of that first property.
So the creation, the day the proceeds from property one goes in the 1031 exchange to buy property number two, that's when your clock starts ticking.
Yes. And you're not holding the money yourself this whole time. You need to have a facilitator. So there are certain companies that help you with this process, and they actually take the funds and manage the whole process for you. So make sure that you team up with a really good facilitator.
Actually, guys, if you just want to give me a call, I've got a big list of facilitators. I've had been fortunate enough to have the opportunity to have clients do lots of 1031 exchanges. I just thought that speaking with Lacey, this is just a really amazing vehicle that I think more individual investors should be taking advantage of to really increase your wealth through real estate. So rather than, when you sell a property, rather than paying these, $20, $30, $50, $100,000, depending on how much you're making on it in taxes, you're able to take that money, reinvest it into the future and still improve your basis even more. So, eventually you'll have to pay taxes on it, but it gives you $100,000 or, whatever your tax liability in additional leverage to purchase your next.
Right.
So, right. A really powerful vehicle. Was there anything else you wanted to add on that?
Sorry. Yeah. So tax law, you said you could defer the tax liability. So the way that it's set up right now is that when you pass away, your investments, your property is actually passed on to your children at a step up, and you get the step up in basis. So essentially the fair market value at that time. So if you hold the property all the way through your lifetime, then you can permanently avoid paying taxes on that because once it gets passed on to your children, it's a fresh start with them.
Wow. So if you acquired an investment portfolio of buy and hold renters that eventually paid for themselves over your lifetime, and then that you acquired with a 1031 exchange, when you passed and left those to your children, the taxes are abated completely, and your children, that's quite a legacy that people have a chance to leave.
Definitely.
Yeah. Wow. So that's great information. Thank you. That's going to help me. I think Kelly and I are going to go out and buy another investment property here soon. So to make sure our family's taken care of, leave a little legacy through real estate, little wealth, passed on to our heirs. So Lacey, thank you so much for bringing us this wealth of information. I appreciate your time today. Guys, she's probably busy until tax season's over here, but make sure 21, 22, if you have any questions, Lacey is a brilliant wealth of knowledge to have on your team. So thank you for joining us today, and look forward to seeing you again next.